I analyzed the 10 most popular equity ETFs in the world, and I ranked them from elite all the way down to avoid based on factors like diversification, performance, and cost. In this video, I'm going to share my full rankings of all 10 of these ETFs so you can make the best investing choice for you. Now let's kick things off with ETF number 1, which is VOO. This ETF is made by Vanguard and it launched back in 2010. It tracks the S&P 500 index, which offers investors broad-based market exposure to large-cap U.S. stocks. Now, VOO has quickly grown to become the largest ETF in the world with more than $765 billion in total assets. And when you dig into the details, it's no wonder why this is. VOO holds all 500 companies in the S&P 500. It offers up a dividend yield of 1.14%, and yet it has an expense ratio of just 0.03%, which is very low. Now, VOO is widely diversified, although its top holdings as of 2025 include Nvidia, Apple, Microsoft, Amazon, and more, so many of the largest companies in the world. And the long-term performance of this fund has been great, with a compound annual growth rate of about 15% since its launch in 2010, which turned about a $10,000 investment into about $80,000 by 2025. Very solid returns. Now, overall, VOO is a great fund that tracks the S&P 500 for next to no cost, and it's a core holding for millions of investors. So I give this ETF an overall rating of great. Now, ETF number 2 is IVV. IVV was created by iShares and it was launched way back in 2000. Now, just like VOO, IVV also tracks the S&P 500 index. In fact, IVV is almost identical to VOO in every single way. It tracks the same 500 companies, it has the same low expense ratio of just 0.03%, and its long-term performance is nearly identical. The only difference between IVV and VOO is the issuer. IVV is issued by BlackRock, while VOO is issued by Vanguard. Another difference is that IVV is older, so it has a longer-term track record in place, and it has delivered a 24-year compounded return of about 9.8%. Now, the reason that VOO has a higher return is simply because it was issued during the start of a bull market. IVV's returns are dragged down by the dot-com crash, the 2008 crash, and the 2020 crash. Now, just like VOO, I think that IVV is an excellent choice for long-term investors, given its stability, low cost, and broad market exposure, so I would give this an overall rating of great. Now, ETF number 3 is SPY. And SPY was the first ever ETF launched by State Street all the way back in 1993. And just like IVV and VOO, SPY also tracks the S&P 500. Now, this fund is identical in nearly every way to both VOO and IVV, except for one important difference. SPY has an expense ratio of 0.09%, which is low in absolute terms, but it's triple the cost of IVV and VOO for the exact same fund. Now, SPY's long-term returns are really great, compound annual growth rate of 9.8%. So if you put $10,000 back into this fund in 1993, you'd have about $275,000 today. So this has been a fantastic long-term holding for investors that are early to the ETF train. However, since SPY is effectively the exact same fund as VOO and IVV, but it comes with an expense ratio that is triple the price, I'm actually going to put this fund on my avoid list. That's not because it's a bad fund in absolute terms, but I see no reason to ever own SPY if you could own VOO or IVV instead. If you're enjoying these videos and you're interested in exchange-traded funds, I made some very popular infographics that explains the basics of ETF investing, and I compiled them into a free ebook. If you want a copy of that, just visit longtermmindset.co/ETF and let me know where to send it. Now, fund number 4 is VTI. This is another Vanguard fund, but this one owns the total stock market index. This fund launched all the way back in 2001, and since it owns the total stock market index, it gives you exposure to the entire U.S. stock market, including large caps, mid caps, and small cap funds. Now, VTI has an incredibly low expense ratio of just 0.03%, and it offers extreme diversification with more than 3,000 holdings in total. Now, while there's plenty of overlap between VTI and the S&P 500 funds we've talked about thus far, this fund has a lower concentration in the top 15 holdings than the S&P 500 funds, and it holds a few thousand more stocks. That is an important distinguishment between the funds we've talked about thus far. Now, if you look at the long-term returns of VTI since it was launched, they've been really great. A compound annual growth rate of about 10.1%, and that's despite launching right before the dot-com crash of 2002. If you put $10,000 into this fund at its inception, you'd currently have more than $88,000 in 2025. Now, because of the additional diversification that VTI gives you in comparison to the S&P 500s we talked about thus far, and the fact that this fund is extremely low cost, I think that VTI is the closest thing that exists to a buy and forget investment, so I'm going to rank this in the elite tier. Now, fund number 5 is QQQ. This is an ETF by Invesco that tracks the 100 largest non-financial companies listed on the NASDAQ stock exchange. It was founded way back in 1999, and it owns a lot of tech and growth-focused stocks. Now, QQQ is an absolutely massive fund, but it's also the most expensive ETF on this list thus far, with an expense ratio of 0.20%. Now, this fund is also highly concentrated. It has 102 holdings in total, and 61% of this fund's assets are in the top 15 stocks. Now, despite those seeming negatives, one overwhelming positive of this fund is its stellar long-term returns. This fund has generated a 13.5% compound annual growth rate since it was founding, which is astounding given that this fund launched right before the dot-com bust. So if you put $10,000 into this fund right at the get-go, you would have more than $139,000 by the end of 2025, which is an outstanding long-term return. Now, while this fund is on the expensive side for a passive ETF, given its amazing long-term outperformance, I'm actually going to rank this fund in the elite tier. This is a fund that I believe can power strong returns for investors that have an iron stomach and a long-term holding period. Now, as a side note, if QQQ does interest you, make sure you check out QQQM instead. This is the exact same fund issued by the exact same company with the exact same holdings, but it has a slightly lower expense ratio, which makes it the better choice for buy and hold investors. Now that brings us to fund number 6, which is VUG. This is Vanguard's Growth ETF, and it was launched in 2004. Now VUG is a themed ETF that focuses on large cap growth stocks, and it tilts heavily towards the tech sector. Now VUG is similar in QQQ to many ways, but it has a few important differences. First, it has a much lower expense ratio of just 0.04%. Secondly, it has 60 more holdings than QQQ. Despite that, it's worth noting that this fund is even more concentrated than QQQ, with 68% of this fund's assets in its top 15 holdings. As you'd expect, this company's biggest holdings are Nvidia, Microsoft, Apple, and all of the other mega cap companies. Now, VUG does have a very strong total long-term return, compound annual growth rate of 12.2% since it was founded. And if you put $10,000 into this fund way back in 2004, by the end of 2025, you'd have more than $122,000. So overall, VUG is a low-cost way to ride the growth of the most innovative companies on the market. So I think that it's a solid choice for long-term investors, which is why I'm going to give this a rating of the great tier. Now, fund number 7 is VEA, which is our first international-focused ETF. Now, this is another Vanguard ETF that provides investors with an easy way to invest in a diversified basket of stocks located in developed markets around the world, such as Canada, Europe, and Asia. Now, VEA is hugely diversified, with more than 3,800 stocks in this single fund. It also has the lowest concentration in the top 15 stocks at just 13% of the fund. Now, income investors will also like that this fund offers a dividend yield of over 2.7%, and it has a dirt cheap expense ratio of just 0.3%. It is worth pointing out that the bulk of VEA's holdings are found in European companies. About a third of them are in the Pacific, and the remainder is elsewhere in the world. So while this is an international fund, most of its assets are in European and Asian countries. Now, if you know anything about international stocks, you probably are aware that they have dramatically underperformed their US counterparts over the last couple of decades. That's why if you put $10,000 into this fund when it launched in 2007, you'd only have $20,000 today. That's a compound annual growth rate of just 4.3%, which is the lowest return we've seen thus far. However, this fund's long-term track record of performance is quite poor, and demographics and innovation are working against many of the countries where this fund invests. Having said that, this can be a good choice for those seeking diversification away from 100% US exposure. For that reason, when taking everything in, I would give this a good rating, but I wouldn't give it a great rating. Now, fund number 8 is IEFA, which is another international-focused ETF. IEFA was launched by iShares back in 2012, and it also tracks international stocks in developed markets, excluding the US and Canada. Now, IEFA is also hugely diversified, just like VEA, with more than 2,600 stocks in total, and it has a very low concentration in its top 15 stocks at just 15% of the fund. It also has the highest dividend yield we've seen so far at nearly 3%, although it does have an expense ratio on the higher side of 0.07%. Now, the majority of this fund's assets are listed in Japan as its number one market, the UK as its number two, and then a slew of European countries after that. Although it's worth noting that none of this fund's assets are in India, China, or Africa. So how is this fund done over the long term? Well, if you put $10,000 in when it launched in 2012, you currently have $26,000. That's a compound annual growth rate of about 7.7%, which is higher than the EFA fund we just saw. Now, overall, I do think there are some positives to IEFA, but given that this fund excludes Canada, has less companies overall than VEA, excludes some of the countries that are in VEA, and has a higher expense ratio than VEA, I'm actually going to put this fund on my avoid list, since I personally view VEA as the better choice for international exposure. And to be clear, just because it's on my avoid list doesn't mean it's a horrible choice. I just think there are much better options out there for those that are seeking international exposure. Now, fund number 9 is VTV, which is another one of our themed ETF. Now, this fund was launched by Vanguard back in 2004, and it focuses on the largest US value stocks on the market. Now, VTV holds about 300 companies, and it has very modest concentration in the top 15 stocks at just 27% overall. This fund also has the highest dividend yield of all of the US focused ETFs on this list, and it has a tiny expense ratio of just 0.04%. Taking a look at this fund's long-term track record, it's generated a compound annual growth rate of about 9.2% over its 21-year history. That means if you put 10K into this fund back in 2004, you'd currently have $67,000 by the end of 2025, which is a pretty good long-term return. Now, one thing that surprised me about this fund was actually how volatile it is. Given that this fund focuses on valued stocks, you'd expect it to have lower volatility than the S&P 500 in general. However, if we match up this fund to that of the S&P 500 and we look at the total drawdowns, you'll actually see that VTV's drawdowns were more severe than the S&P 500 during the 2008 financial crisis, and the volatility has persisted in every downturn since. The only time it was less volatile than the S&P 500 during a crisis was during COVID, but this fund still saw double-digit drawdowns. That was surprising to me given that this fund focuses on lower-cost value stocks. Now, if you're looking to simply increase your income from US stocks, VTV does seem like an inexpensive fund to do just that. However, given that this fund's drawdowns were even more severe during the S&P 500 during 2/3 of the last financial crises, I'm actually just going to put this in my good category, as I don't think this fund delivers on all of the promises that investors have when they buy into it in the first place. Now, that brings us to fund number 10, which is IWF. This fund was launched by iShares back in the year 2000. Now, this is another themed ETF. In this case, it focuses on owning large and mid-cap US equities that exhibit growth characteristics to them. Now, IWF owns 393 companies, which might seem strange since the number 1,000 is in the fund's name. Now, in addition to that, 67% of this fund's assets are just in its top 15 names, which makes it one of the most concentrated ETFs on this list. It also has the second highest expense ratio that we've covered thus far of 0.18%. Now, despite those negatives, this fund does have very solid long-term returns, generating a compound annual growth return of 11.2% since this fund launched in September of 2001. That turned a $10,000 investment back then into $78,000 by the end of 2025. In total, given this fund's higher level of concentration than the other funds on this list and its high expense ratio of 0.18%, this isn't ever a fund that I would personally want to own. For that reason, I'm actually putting this on my avoid list. If you're the type investor that's looking for growth, I would personally rather go with QQQM or VUG instead. Again, this isn't necessarily a bad fund, it's just on my why bother when there are clearly other funds that are better that exist. As a reminder, if this video was helpful, I made a series of infographics that explain the basics of ETF investing, and I compiled them into a single ebook. If you want a free copy of that ebook, just visit longtermmindset.co/ETF or click the link in the video description. Well, thanks for watching this video. I hope you enjoyed it. I'm Brian Feraldi, and I'll see you in the next video.